one of the last topics that I'll be talking to you today about is remuneration planning. Well, basically, what is remuneration planning? The way I see it is that you're trying to get the most income out of the company, but in the most tax efficient manner, basically. Okay, and I'm just going to concentrate on salary versus dividends today, and just looking at how dividends are much more better than salaries. I mean, in most owner-managed businesses, they have the flexibility, they have the option to choose how they want to take their money out of the company, whether they want to do it via salary, whether they want to do it via dividends, bonuses. You know, they've got that flexibility. But with the increasing national insurance rates and the reduced, and I suppose reducing corporation tax rates, we would actually say a dividend-based extraction strategy would definitely be much more favourable and would give you a better result than actually taking your money out as a salary or bonuses. And just to kind of illustrate that actually works, I've got an example. On the next slide. Oh, it's actually at the end, so I'm going to come back. I've got this, it's in your packs as well. Okay, and what does this example show? So let's say we've got XYZ Limited, we've got Mr. A, he's a director in XYZ Limited. He's currently on a salary of £60,000. Okay, this tax year, the current tax year, 14-15. So he's on a current salary of £60,000. We've calculated the tax, the employee's national insurance. So his net take-home for the year would be just under £42,000. So we've turned around and said, OK, well, we'll give you a remuneration plan. We'll say we'll give you a salary of 7,950. Why 7,950? We've taken the national insurance limit, so it pays no national insurance if he gets a salary of 7,950, no income tax because it's within the personal allowance. Okay, so he's getting that all cash in, well, not cash in hand, but that will be his net receipt, 7,950.
Sorry, and it's 7,950 because when you stamp still gets paid.
Yes, that as well. Yeah.
That 7,950
Yeah,
limit.
yeah. So you're within that. Okay, and then we'll say, okay, 60,000 less the 7,950. What is the remainder that we can pay out as dividends? It's 52,050. But we want to keep the cost to the company the same. The fact that we want to take it out as dividends, but not as salary, but we don't want any impact to the company or any extra cost to the company. So we're taking into account the employer's national insurance and the corporation tax. So it gives us an equivalent of what we can actually take out as dividends instead. So that's the 47,386. So we need to gross that up, calculate the tax on that dividends. So the net receipt on the dividends is the 43,170. So the total, basically what Mr. A would take in his pocket under the remuneration plan would be the 51,120, which is the 790 plus the 43,170. So just looking at the saving on that remuneration plan compared to a salary is just under £10,000. So I mean that's per year, and I mean it's great stuff. So dividends definitely is a better extraction strategy than salary or bonuses. Okay. Right. Whilst we're on dividends, two things that I want to mention about whilst we're on dividends. One is the settlements legislation, and the other being the PA Holdings Limited case. I mean, the settlements legislation, we've got the Arctic Systems case, which you may or may not have heard of. That gives us great comfort, the Arctic Systems case. But let's say if you had arrangements which existed where the settlor would benefit, or if you've got shareholders with minor children, they would benefit, then there would be issues. There's more, consequences with that. But generally, just to summarise it, I would say, following this Arctic System case, settlements legislation can actually be easily managed if you gift proper shares. So as long as you gift proper shares to other individuals, then you're fine. It's not, you can easily manage the settlements legislation. On the other hand, we do have this PA Holdings case, okay? I mean, that is just a very complicated tax avoidance scheme. If I was to even summarise it, I mean, there's pages and pages long on PA Holdings case, but if I was to summarise it, I would say it's a complicated structure. They designed it in such a way where they were trying to convert the earnings, bonuses into dividends, plus getting a corporation tax deduction on it, and they did this via a special purpose vehicle. So it was absolutely complicated. The case went to the Court of Appeal, and the final decision that came out of it, that the amounts in question, they are definitely earnings and they're going to be taxed as earnings. So, so we do have that on one extreme, and then on the other we've got something like the Arctic Systems case, which does give us great comfort. But again, if proper payments of dividends are going to be made to shareholders who have got proper shares that they hold in this company, then you are not affected by this PA Holdings case. Okay, so yes, just be wary of the fact that they exist, but again, just 2 points. If you're gifting proper shares and making proper payments of dividends, to shareholders with proper shares, then that's the key, and you're safe and sound. Okay, so that's a point to kind of just bear in mind. Just another planning point, last planning point, income spreading around family members. Again, if you want to give shares between your family members to try and spread the dividend income. Alphabet shares is another thing that just gives you alphabet shares, basically different classes of shares to different individuals, just giving you that extra flexibility so you can pay out different levels of dividends to different individuals with the different classes of shares. So that does give you that extra flexibility and just control it a bit more if you wanted to do that. It's a bit of a planning point there.